in this episode.
In the '08 crisis, when he invested in Bank of America and Goldman Sachs, he had deal terms others did not have. He defined the game that he was playing. As he says often, you got to choose which swings you take. You don't have to take all the swings.
I've been investing in semis for 30 years, as probably you have. They're cyclical. Semis are cyclical. It is a cyclical industry. It is not a secular growth. It's going to be cyclical, boom, bust, as it always has been.
Now the U.S. is the envy of the world. And now China's trying to encourage domestic demand consumption. So it's such a funny turning of the narrative between the U.S. and China. Welcome to Non-Consensus Investing. I'm Ram Ahluwalia, your host and CIO at Lumina Wealth, where we specialize in the craft of alternative investments. At Lumina, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary. Welcome to the next episode of Lumina Non-Consensus Investing. I'm pleased to be joined by a friend and special guest, Michael Weinberg. I've known Michael for over a decade now. Michael has had incredible experience as an investor. He worked directly for George Soros, investing for his personal account. He was at Protege Partners, notable at the very least for having made a bet against Warren Buffett, whether the S&P would outperform a bunch of hedge funds. So we'll talk about those experiences. Michael is like a global citizen. He's got views around the world, including on China. We'll talk about that. Commercial real estate, are hedge funds dead or not dead? Opportunities in privates and illiquid and evergreen funds. And he was also part of the rise of the hedge fund sector as well. When you were at FRM and allocating to different managers and quantitative strategies. So pleasure to have Michael join us here today. Michael, thank you. How are you?
Thanks for the kind and warm introduction, Ram. That was very nice. It's been great knowing you over the past decade and more, and look forward to the discussion.
We'll have a lot of fun. I think it was in 2011. You actually interviewed me, and now I get to turn the tables.
That's right. And that was really like the early precursor before there were podcasts, or if they were nascent at the time.
That was a great show. I happened to give it a re-listen, and I'm always hypercritical about anything I've said. I remember listening to the pod, and we were talking about single-family rentals and buy-to-rent, which was a great move. We also talked about the Yardeni rule, and we talked about the S&P. I remember saying it was in May, and I said the S&P is totally overvalued. I think it's worth buying now, and I was cringing because clearly the 2010s were a bull market. But I timestamped it. And in fact, the S&P went nowhere, corrected in October, 6 months later, and then it was off to the race. So I felt good about that. But we're going to talk about a couple different topics. First off, what was it like to work for George Soros? And when was that?
It was the late 90s during the first tech bubble. And it was incredible. It was one of, if not the highlight of my investment career. And it was not just working for George, it was working for George and Stan Druckenmiller and Scott Besson. And to me, all three of them are among the best macro investors alive and over time.
What were some of the learnings that you took away from there? I think folks might be familiar with the concept of reflexivity. Maybe you can introduce that. Druckenmiller's obviously got an extraordinary track record, one down year. He was so nervous to the stress or burden of managing LPs, he just returned their capital and started investing for himself. But what were your under the cover insights into those investing strategies?
I think one of the things that made all three of them great was their risk management. I'd say one, stopping out losers. If you look at George has written extensively about this, every day you should reevaluate your positions in your and this applies to everyone. You should reevaluate your positions in your portfolio and say, if I wouldn't want to own it today, then I shouldn't own it. Now, obviously that's easier with liquid securities like equities than illiquids and privates, where you may have to go to a secondary market. Along the lines of risk management, for example, if I think back to Stan, one of the things Stan did great was if the portfolio was not behaving well and down significantly, he would just say, look, if I'm down, I forget the number, 15 or 20%, I can still come back from that. I'm going to cut my losses, refresh, reboot, restart, and reevaluate everything.
Druckenmiller would go to cash if he had a 15% drawdown and then reassess. And then what would he do? Just hang out for a week or a month and then get back in?
No, he would go to cash and then reassess. And then if he said the right thing to do is potentially get back, he would get back. The point is he would cut them so that it was like he's starting with a clean slate. The conclusion might be to get back in the same positions, but the point was get rid of those, refresh, restart.
That's super interesting because there is this bias, according to Kahneman and Tversky, around the endowment effect, where people tend to value what they own more than that which they do not own. People don't want the cognitive dissonance of being wrong with their prior selves. They want to maintain some continuity there. And I love the point you raised earlier of assuming when you wake up that you've got the wrong positions, which is a Paul Tudor Jones quote as well. Now, Druckenmiller is known for being long momentum and long trends, right? So Soros and Druckenmiller would own futures contracts too. Unlike equities, if equities drop 15%, it's probably time to buy because they're mostly corrections. You probably should. Whereas if you have a commodity, it's a different kind of scenario. I just want to clarify that for the audience so people don't start going to cash right when they're probably at the bottom of a correction. It's a different kind of model here. Could you double click on this concept and theory of reflexivity? Like, what is that about?
Yeah, George was always a fan of quantum mechanics, hence the names of our funds at the time were quantum, quasar, quota, and things often related to quantum mechanics. Quantum mechanics is Schrodinger's theory, and basically the act of observing impacts what you're actually observing. One of George's points with reflexivity is the act of being a market participant impacts the very market you're observing, and it's reflexive. And I think the easiest way to elucidate it for listeners is boom bust. George is quite well known for that, and he's written books about this. You have the boom, which is self-fulfilling and reflexive, and then you have the bust, which is also a self-fulfilling and reflexive. And when I was there investing on his behalf and with him, we had the first tech bubble. We knew it was a bubble. That was pretty clear. As the stocks got richer, more people bought them. There was more momentum. The valuations got richer. They could then have a more highly valued acquisition currency. They could buy more equities, which in turn were accretive to earnings. And the valuations actually got lower. You could make the argument that they're less expensive again, and on it went. A good example is like to this day, like Amazon buying Whole Foods, right? Amazon's a very richly valued stock, and Whole Foods was a very relatively, Amazon's valued as a technology stock and Whole Foods was valued as a grocery stock. There was a huge accretion to the earnings from Amazon buying Whole Foods. There are the leverages and the synergies and all that. It's a good example where you use an expensive acquisition currency to buy something less.
Leverage accelerated that because if you're buying on margin, and margin debt was a big deal in the dot-com era. Now we call it zero DTT options. It's synthetic leverage. And obviously OA featured a lot of leverage through securitization. So leverage just shows up in a different kind of financial innovation. If you bought something on margin and the stock went up, then your margin consumption actually went down. And so you can afford to buy more. And then in reverse, when stocks are dropping, you got a margin call, you got to sell assets, others are selling. That dynamic seems to explain why markets overshoot on the upside and overcorrect on the downside, combined with psychology.
Yeah, it's exactly what you said. And it was working. So people's view was, it's working, I should do more of it. As we both know, with hindsight, most capital went into the NASDAQ in the fourth quarter of 1999 or possibly first quarter of 2000, right at the top. Exactly when everyone should have been selling, most people were going in. Yeah.
Now, one of Druckenmiller's regrets is he actually did get out of the market. I think it was either early 2000 or end of 4Q 99. And the market kept going up. It was going parabolic. And allegedly there were others at Soros that were still in it and still making money. And he decided to get back in the market and he top ticked it on that day. And he has some regret for that. I guess the question would be, how did they temper their emotions? And did they have tools to govern their decision making and say, okay, here's the mechanical rule that I'm going to use to identify where we are and get out?
Stan did it was more that Stan, it's very public. Well, everything I'm saying is very public. At that point, Stan separated from George after being the longest tenured CIO at Soros and the longest tenured CIO since. I think it was more that dynamic. Otherwise, Stan would have figured it out and gotten right back on performance back around. It was just a time for Stan and George to go separate ways. And that really was what happened there.
Liking what you hear? Subscribe and follow Lumina Wealth to catch every new episode. Your engagement helps us bring top-tier experts and fresh insights so that you too can invest beyond the ordinary. So don't miss out. Subscribe and follow us now.
And what was the overall approach? Was it primarily trading futures contracts in like a concentrated position and focus on momentum, or was it interpreting the macro? How would you summarize a strategy that was applied during your experience there?
Yeah, it was definitely macro driven by combination of Stan, Scott, and George. Alpha from security selection from the PM team, including myself, but many other brilliant PMs or more brilliant PMs. And so there might have been a top-down theme from Stan. We want to be long technology here. We understand it's a bubble, but it's a good time to speculative be long. And the view was our role is to make money for our investors. And if it's a bubble and the momentum's working, George and Stan had a great deal of history riding bubbles up and riding them down. First making money on the long side and then the short side. The view was that we want to be long technology, and then people like myself would go out and figure out what the best longs were, as well as shorts. We also did have shorts on. I think if it weren't at the point in certain people's careers where it was time to make changes, we would have gotten right back on that saddle and caught the 3-year bear market subsequently.
In your interactions with Soros, any other observations from a personal perspective or Druckenmiller in terms of disposition or behavior patterns, maybe around fitness or routines that you think help them invest better?
Yeah, I mean, the discipline, the hard work, the devotion, the love of investing, that was common among both of them.
How did that manifest?
The work ethic.
So like they're in 24/7. Are they always, there's no Slack now, there's no Twitter back then, right? What did you see on the ground?
Hard work, immersion in the markets, a passion for it, hearing different views, again, being a Socratic or we had a weekly meeting where it was a Socratic dialogue and anyone could say anything without fear, which promoted differing views, exactly what you want. Always asking, where could I be wrong? How could I be wrong? Has the thesis changed? And if so, how? Does that invalidate it? Do I need to do something differently?
Got it. And what did the investment process look like? So there's theme identification, you're betting on a theme, you find the right way to express it at a security level, and then you reassess every week. And then in terms of daily routines, what did that look like?
On a daily basis, the PMs would be doing their work on the securities and constantly updating, particularly Stan, but also George, on what was going on. There were some short-term trades and there were medium-term trades and there were long-term themes, but you're constantly updating them on what's going in line with expectations, what's deviating from expectations, why your thesis still holds or why it doesn't, and why you should move on or take a profit or cut losses.
Got it. Great. So let's step forward then. Now you're a Protege Partners, and Warren Buffett and Protege make a bet around who's going to perform the S&P 500 or a basket of hedge funds that Protege selects. Walk us through how that came about and what that experience was like.
Yeah. So just to be clear, the bet was 10 years. I missed the first 5 years of it. I joined as a partner for the second 5 years.
So you're off the hook because they didn't pick the right ones. We know that.
No, it wasn't our. And again, everything I'm about to say is public.
Yeah, sure.
My former partners have talked about it extensively and it's been written about. But look, we wanted to pick a basket of the world's best hedge funds, like a handful, very concentrated, but Warren wouldn't let us do that. He insisted on a multiple fund of funds.
Oh, okay. Multiple fund of funds. You got fees on fees and
right.
Diversification. Those two things go against your ability to perform. Otherwise,
and
you could have picked a couple.
And that wasn't unknown to Warren.
Yeah.
Fees, correct. Fees and over diversification on a look-through basis. If you picture multiple fund of funds and one fund of fund had 10 equity managers with 100 positions, that alone would be 1,000 positions. Then if you picture multiple fund of funds, you've got multiple thousand positions. And by the way, that assumed those estimates. So you picture this over diversification with high fees. No surprise we underperformed, but I think there were mitigating factors why it was a good bet for us.
It was great PR for Protege. It was great PR for Buffett. It is quite interesting. If you're betting on a fund of fund, the fund of fund is selling diversification. Like, how can you possibly beat the S&P 500 if that's what you're betting on? Buffett picks his games wisely, right? He set it out from the very beginning. Look, he's done that before, right? In the '08 crisis, when he invested in Bank of America and Goldman Sachs, he had deal terms others did not have. He defined the game that he was playing. As he says, you got to choose which swings you take. You don't have to take all the swings. So did the PR actually help Protege? Certainly Protege is forever ensconced in people's memory banks because of this seminal bet. But was it good PR in the aftermath?
Yeah, no, it was great because anywhere in the world we went for that 10-year period, if they didn't know who we were, then we mentioned the Buffett bet, and then they did, and they would say, "Oh, that's you." And to this day, when you mention Protege or the Buffett bet, they're still intertwined. The other thing I'd point out is that we donated. It was $1 million bet. Initially, we each put, I think it was somewhere between $250,000 and $500,000 in a zero coupon bond. And because the rate rally was so strong, it hit par. And we both agreed this is silly. There's only downside. Why would you own a zero coupon bond at par? So we each agreed to sell it and reinvest the proceeds in Berkshire stock. So it ultimately became worth $2.2 million. And that was donated to the charity of Buffett's choice because we lost, which was the Girls of Omaha. There's this fabulous girls center that does great work to this day and for the future, which helps these girls who need help in Omaha. And he was a gentleman about it and said, even though he didn't have to, or he could have chosen the name, he named it after us. So there's the Protege Girls Center in Omaha. The website's up and you can take a look. Donate.
Very charitable. What a great conclusion. Doing good by doing well, by doing good. We talked about hedge funds for a bit. Is hedge fund investing dead?
The industry is huge, but there's very
From an
little
investor
margin.
perspective, doesn't make sense.
I think it depends on who you are, what your objective is, and what your constraints are. For example, for private wealth, high net worth, incremental hedge fund investing is largely minimal. There are two reasons: complexity and the tax inefficiency. They're complex, and most private wealth, high net worth, and some family offices don't really understand the complex hedge fund strategies that you and I grew up in, and we both invested in and deployed and appreciate. And then the other thing is just the tax inefficiency. If to the extent that the income's ordinary gains, it doesn't compare with private equity where it's generally long-term capital gains.
Exactly. That's a key point, right? The hedge fund is going to issue K1s to limited partners with short-term or long-term capital gains. And if you own an ETF, ETF's not taxed on in-kind transactions, and it can internally compound up until you sell the ETF, at which point you pay the taxes. I believe all these hedge funds should convert to an ETF structure if they have the long-term interest of the shareholders in mind, but they don't because you can't charge incentive fee.
No, that's right. That's one fair point as well. For the very well off, there are more tax efficient ways to engage in hedge funds like PPI, LI, private placement life insurance.
We should have a whole episode on private placement life. These are the strategies where you can combine the best of investing with the best of tax. Michael's right. If you can take an inefficient strategy like Millennium is a world-class hedge fund pod shop, the returns aren't nearly as high as they used to be back when you and I were investing in Millennium. But if you can wrap it with a tax-efficient vehicle like life insurance, then it's attractive. Pensions and endowments can take advantage of that because they're not taxable entities, whereas family office and investors are. The other thing I would say is that what you and I would look at back in the day were more novel strategies, these niche capacity constraints where there's an identifiable opportunity that you can get after. The classic long short hedge funds, that seems like it's picked over. And it seems to me that a lot of these hedge funds are like cult of personality and their risk adjusted returns aren't terribly great, but there are a handful out there that still add a lot of value. Are there categories within the hedge fund sector that you think are interesting, maybe due to the nature of the asset class that they're investing in or the specialization that's required to invest well?
Let me just clarify. So we really were focusing, first of all, it's a $3 trillion industry, right? It's not dead, right? It's just at mature on a net basis, on an annual basis. The flows are pretty close to zero for many years now and likely prospectively. For institutions, I think they're very sensible. Again, if you understand the strategies, you're capable of manager selection. They have a valuable role in portfolios. At APG, the Dutch pension, I ran one of the world's largest, most sophisticated, this is a personal view now, profitable alternative portfolios, which included a material percent of hedge funds. It was probably one of the world's 5 largest hedge fund portfolios. And they did great for us. The risk-adjusted returns were there. We had favorable fees. It was a very compelling proposition that complemented, as a completion portfolio, the rest of the firm's long-biased, long-only portfolio.
That's a fair point. And I think the key there is there are managers that can access a category and it's a niche and they can potentially do well. For example, structured credit's a classic example. You can't express views in structured credit in public equity markets. There are no ETFs indexed to residential mortgage-backed securities. So you need a specialist. If you can complement an existing portfolio and you have the manager selection skills, then you can do well. I don't see them as wealth creation vehicles. Most of my criticism is directed at these long-short hedge funds exemplified by the HBO show Billions, which is really entertaining. Point 72 makes money, but you can't invest in that. If I can invest in Point 72, I would. If I can invest in like SAC, which I would do that. If I can invest in Citadel, I would do that too. Those are my free alpha giveaway for everyone here. I'd invest in 2 Sigma if I could as well. Also Renaissance. Am I missing anyone? Those are the ones you want to invest in, but they're not open. You can't invest in them.
Right.
The GPs, right? I mean, so they have funds, but actually you're right. Technically Renaissance does have a fund that's open, but it's terrible. The proprietary funds that the staff and the principals invest in, you can't invest in those. Same thing with 2 Sigma, right? 2 Sigma has the one that's, you can invest in that. It's just not the same as the proprietary product.
Yeah, Ram, we've watched this for 20 years, right? The highest alpha, typically highest frequency, most scarce capacity, what you want to own is almost, if not entirely, relegated to founding partners and or senior staff. And to your point, that's the case at most of the firms you mentioned. Certainly Renaissance, D, Shaw, 2 Sigma, and on it goes, where, look, to your point, the numbers of Medallion are now very public. I think Greg published them in his book, and the numbers of Reef are quite public. So you can see the spread is immense. I've actually had the pleasure of being invested in both funds.
Wow. Those are Jim Simon's funds for those tracking here. So congratulations that you got in those funds. Was that at FRM?
I can't say where, but within my career at multiple firms, I was in both of those, including the crown jewel one. I just can't say where, but
Alpha was the access to the deal and recognizing that it's a good opportunity and moving.
To your point, their GP stakes, which is effectively a permutation of seeding. At FRM, we had a seeding business, which I was involved in helping found. And at Protege, we were known as small emerging managers and seeders. Seeding is very lucrative. The new flavor of the day is GP stakes, but GP stakes are really seeding. You own the GP.
Blackstone has a business around this too, and a few others. It was a big deal like 10 years ago or so. I guess it's coming back. Foundation Capital is investing in a bunch of these GP stakes. It's a great business, good economics, especially if you have permanent capital. That didn't really go anywhere with Bill Ackman and his attempt to launch a permanent capital vehicle. Any thoughts on that?
Look, Bill is brilliant. I think he's had a lot of great investments. I'm just quite surprised at the valuation he got away with before he canceled the offering recently. I don't know if you saw, I think it was a $10 billion, the valuation. He sold the stake in his management company in the GP. The valuation he got was incomparable to publicly traded asset managers.
The close though, right?
No, there are two things.
Okay.
The one didn't close is the one that he was trying to raise that initially 25 billion. That didn't close. But before he went out to do that, he sold the stake in his GP to a bunch of institutions.
Oh, correct.
Yeah, it was either 100 million at a billion valuation or a billion at a 10 billion valuation. The valuation he got on that was so off the charts in terms of richness compared to valuations of publicly traded hedge funds and alternative managers. Remarkable to his credit.
That's amazing. We'll ask the AI what the economics were on that. So he did that deal and then tried to do a permanent capital vehicle, which is probably one of the best business models you can have if you're an asset manager. You can deploy capital in dislocated market opportunities without having to raise a private equity fund with a mandate focused on that, which is one of the edges Buffett has. Let's move forward on another topic, talking more about macro.
Yeah, I just looked it up. He raised $1 billion in a funding round worth 10% of the management company, implying a 10 billion valuation. His AUM, I think, is about 20 billion.
So he priced his company at half of the AUM of the business.
That's what I'm saying. Yeah, 18 billion. I just Googled it, but 18.3 billion at about 50%. Good for him.
Who are
Amazing.
LPs that bought into that? We need to have a conversation.
They're public. Some of them are public. I will not comment on that, but they're public.
I can call them out. Family offices, institutional investors, sovereign wealth funds, pension funds, endowments. Sovereign wealth funds aren't necessarily the best investors that we've seen. Harvard's performance has been atrocious the last 10 years. I think it was like at 4% compounded. It was substantially better in the 2000s. I looked at Saudi Arabia's 13F filing. It looks like a YOLO trader degen. It's really terrible. Their call options, their Momo stocks, it was quite something else. You've done some work with endowments too. You want to maybe double click on endowment style investing and what the appeal is there and what's the thought process?
I've taught endowment style investing. There are top endowment investors. It's like any distribution. There's the center and the tails. I've taught endowment style investing at Columbia Business School for the past 12 years, I think. Of course, we co-created, and it's basically going beyond. It's like the Swenson model, going beyond equities and fixed income, beyond 60-40, and incorporating private equity, venture, real estate, hedge funds, commodities, private credit, and any other alternatives, reinsurance, esoteric niche credit, specialty finance, to capture these alpha streams that may provide some diversification benefit or better risk-adjusted return.
I think endowment style investing makes a lot of sense. Ray Dalio explains this concept very well in his books. If you can get a basket of uncorrelated return streams with positive expectancy, then together you should be able to generate an attractive risk-adjusted return and compound wealth. Is that the main idea behind endowment investing?
Yeah, totally. And again, I've been a large investor with Ray historically in my career at different points. It's Ray's concept. It's Swenson's concept. I think actually Maynard Keynes was one of the early endowment investors who get very little credit for.
He did really well. He was one of the best investors and traders of all time.
Yeah, no, and not only that, he basically was the precursor to modern endowment investing, like Swenson, right. Ray, because he went beyond equities and fixed income and invested in commodities and real estate. He was the endowment model over a century ago.
That makes sense. Most investors have exposure to bonds and equities, and there's this concept of 60-40 that has been espoused by legacy wealth managers and Wall Street brokers for a few decades now. Do you think 60-40 is dead? Or do you think there's a better opportunity to have alternatives in a portfolio?
Yeah, definitely am a believer in the better opportunity. I don't think 60-40 is dead. It is what it is, right? But I think you can expand your efficient frontier and generate more return with the same risk or the same return with lower risk by incorporating alts. If you're a family office, maybe it's private equity, not hedge funds. If you're an institution, like when I was at APG and we're not a taxpayer, levered high alpha hedge fund strategies can be quite compelling to complement and generate uncorrelated returns.
Something I struggle to understand is why someone would want to own treasury bonds that are going to generate 5% when I can earn a return in the teens on private credit. I'm giving up liquidity, but if I'm in a senior secured position, I understand the asset, it's cash flowing, and I can have recourse to collateral or the company. That seems like a better opportunity. I agree. I think alternatives are underowned, and a lot of the alternatives that you see from the classic wirehouses are not that interesting. They're very popular, they're very big. They're these asset gatherers that make a boatload of money charging a management fee, but the performance does diminish. So approaching takes some skill and discernment and access. We saw BREIT, for example, the real estate fund, which got gated. Investors couldn't get their money out. I see this with private credit quite often, where multiple different private credit managers will have an interest in a loan, but they market differently. If you go to their 40 Act and look at the terminal, you can see how they mark their positions. The ones that market the lowest are the honest. The ones that market too high, something's not right.
Yeah, look, one, that's a great point. And the spreads between the marks of the same security among different holders, it can be 57, 60 points. I've seen securities, to your point, private credit, where one holder is marking it at 30 and another holder is marking it at in the 80s or 90. It's extraordinary.
It's extraordinary. I don't believe most high net worth individuals have the skill to identify and discern and separate out. It takes the work to do that.
We could spend hours on private credit. You mentioned being senior secured, but now you've had the rise of LMEs, right? Liability management exercises, which a more well-known term would be cram downs, these cooperative deals. Being senior secured maybe is not what it used to be, or you may not be as senior secured as you think you were.
If there are issues around the balance sheet or the company or the collateral that's backing that loan, then yeah, it may not be as secure as you thought.
Hey there, I hope you're enjoying the show. Let's talk about investment opportunities for a second. Remember when everyone was talking about investing in OpenAI as the hottest deal? As they say, invest in the picks and shovels when you have a gold rush. According to Bloomberg, one such opportunity was CoreWeave, the picks and shovels player that powers OpenAI. At Lumina, we specialize in finding these hidden gems before they become obvious. Our insights have also been featured in the Wall Street Journal, Bloomberg, and American Banker. With us, you are in expert hands. If you are a qualified purchaser or an accredited investor, check out our luminadeals.com.
Let's go to the macro front. Where are we with China? So China's been in a bear market. There was some capitulation in early February. It's well off the lows then. We've seen economic data that continues to deteriorate. Property prices, especially for residential real estate, continue to decline. I saw an image a few months ago of Chinese just buying gold bars out of frustration with like equities. That seemed to me like a classic kind of panic signal. And then you've got this party that's really controlled by one person who seems to be breaking with the traditions of passing out the reins to successor generations. You've got entrepreneurs like Jack Ma that are pressured to be silenced. And you've got a lot of emigration from China. So that's the backdrop. Where do we go from here on China?
Look, I've spent considerable time on China for some time now. I'm quite bearish still. I know you just rattled off a number of negative data points, and those are all quite well known. But that said, I think the two analogs are Japan in 1989 and the US in 2007, pre-GFC or post-GFC in '08. They've had four excesses: housing or real estate housing, more broad housing and more broadly, in other words, office, industrial, all of that, to infrastructure, natural resources, and manufacturing. There were two things that drove it and two things that are now an issue. And again, I'm applying a George Soros style boom bust theory here. We had the boom, which was unprecedented and one of the greatest in the world ever in terms of growth and economic value. Now I think we're in the bust, and I don't think the bust ends anytime soon. The two drivers were, of course, their housing bubble drove demand for infrastructure, natural resources, and manufacturing. And then global trade, globalization drove demand for their resources to manufacturing and infrastructure. Now you have the collapse of their housing bubble and deglobalization, onshoring due to pandemics and supply chain weakness and vulnerabilities, as well as geopolitics and strategics. I'll pause there, but I think they don't know what's hit them, and this doesn't end anytime soon. You may have some bounces like Japan had over the last 35 years, but the long-term trend is down.
There's a big difference between China and other countries in that they did not release the monetary spigots as aggressively, especially during COVID. There wasn't back-to-back COVID trillion-dollar stimulus packages. Don't they have firepower to deploy to arrest declines in property prices? And it looks like there's more discussion of that and some action taking place.
I'll give you the answer in a moment. They didn't deploy this reckless, unnecessary, or excessive policy that the rest of the Western world, like particularly the US, did during the pandemic. The caveat is if you aggregate all the levels of debt, local government debt, state government debt, and if you aggregate all those debt levels, it actually comes out similar to the US and Western Europe, I would argue. If you aggregate, you have to go beyond just their federal equivalent level.
It's an excellent point, right? So the leverage may not be at the sovereign level, which is the case for the United States, Western Europe, Japan, and most of the world, but it's actually at the state and local level.
That's right. And they're the ones who are having a real issue now, because their tax revenues were from real estate and or derivatives like sales or real estate, and they're not and they're not getting those revenues because that whole flywheel or virtuous circle or boom is done.
My view is that one, this issue and crisis in China, it's not as bad as the United States in 2008. That's one. And that's, if you believe that, one should be more constructive. It doesn't mean that one needs to invest in China, but one should be saying, hey, what's the right way to think about China around when I should start getting positioned in China? Looking at the change in property prices, maybe the rate of decline is slowing down and looking for it just to level out and turn up, because that would give consumers confidence in the value of their household net worth and balance sheet. Is that a fair way to look at China? Or do you think China's another '08 or maybe even worse than an '08?
Yeah, I respect your opinion, and you're a great investor. I just happen to have a view that it's comparable to the US or worse. If you look at what happened, they're the first tier cities, Beijing, Shanghai's, and then you have the second through fifth tier. And so much of the building, aside from being excessive in the first tier, were in the second through fifth tiers. And so much of the infrastructure was going to the second to fifth tiers. And the whole thing was predicated on rising prices, creating equity. As you said earlier, with the example with margin debt, you have more equity, therefore you can borrow more, therefore you can buy more. Then when you buy another, you need to furnish it. And that whole cycle has just gone in reverse. And again, I don't think the government really appreciates it. For example, recently there's been concern by the government that people are buying too much of the sovereign debt and that yields are going too low. I think they're in for massive disinflation, if not deflation there. And I think those yields go a heck of a lot lower because I think the paradigm is Japan.
It's really quite interesting analysis. The other part, I would say, to support your point, is a demographic situation. Japan, declining demographics, deflationary. China's got that issue as well. They're trying to export EVs and solar, and no one wants it. That creates a glut of production that they're dealing with internally. They can't even find domestic demand consumption for that. And they've got the kind of problems that John Maynard Keynes had in the Depression. Now, this is not a depression because it's not a rolling series of bank failures and all the rest. It's a kind of failure of demand. And then household balance sheets are upside down because of property prices and issues that banks have that exposure to that. I'm more constructive on the health of the banks versus 2008. I will say this, though. There are companies that are generating earnings growth. If you own an asset, what you're buying is a long-term stream of earnings. And I think if a market's dislocated, you want to find the highest quality asset in that market. My bet is on Tencent, but most of China is challenging to invest in. I'm not saying buy Tencent here. We got in shortly after these capitulation lows in early February. It's a challenging market. But I think in 3 years, prices are higher than where they are now.
I just want to add, your demographic point is spot on. They've got that going against them, as does Japan, Europe, and the US, not yet, but will. The demographic thing is just a further nail in the coffin. The other thing is, historically, the Chinese are savers, not expenders. The US were spending
as well. That's a terrific point, right? Exactly. They're savers, and that savings is what drove the investment boom, right? And that was seen as a virtue for quite a long time, for decades, in fact, right? People would look at China and say, hey, look at China. They have better consumer virtues. They save, and then the banks can back to investing. And look at the US and profligate consumer credit debt. Now the US is the envy of the world. And now China's trying to encourage domestic demand consumption. So it's such a funny turning of the narrative between the US and China.
Totally. And I'm a proponent of investment, not spending. In China's context, they're spending an investment and they're saving to fund investment. My view, for what it's worth, again, it's if you don't have the demand for the housing, A lot of the infrastructure is not needed. A lot of the resources are not needed. And a lot of the manufacturing is not needed. If you have this trend of deglobalization, and they're producing less, you need less infrastructure, you need less manufacturing, you need less resources. This is why I view this, it's like a 1-2 punch. Even if you do have the saving, you don't have the opportunity to deploy it because there isn't the demand. And then there are government constraints on exporting capital. So if you export capital, you're not necessarily helping the Chinese economy. This is why I think they have this conundrum.
I agree. The best entrepreneurs are leaving the country. A lot of talents leaving the country. Folks are trying to figure out how to get money out of the country through digital assets, Bitcoin, whatever it might be. I think two other differences with the American approach is, one, there was less of this kind of top-down industrial policy in the United States, although that's changed recently with CHIPS Act and Inflation Reduction Act. And that's one. But two, also, Americans, unlike Japan, post-1988, where there's a lack of restructuring, you had these zombie companies floating around that were effectively insolvent, but there's no mark-to-market concept. After the banking crisis, there was mark-to-market, private equity stepped in, weaknesses in balance sheets were revealed, bailouts unfortunately happened, but you also had private capital participate in that. And that doesn't seem to be the path that China is taking now. I mean, enabling these clearing events to occur, enabling transparency to happen, and enabling private enterprise to determine the best growth avenues as opposed to solar and EVs.
I think it was Paul Tudor Jones and Peter Thiel speak at a Morgan Stanley conference. I think it was the Breakers some years ago now. And they were both not constructive on China because of China's view on entrepreneurship versus ours. You alluded to it, whether it's thwarting industries like the for-profit education, when those stocks were high flyers and had significant market caps, and overnight the party regulated them and effectively diminished their ability to.
Exactly. Jack Ma.
That too.
And that matters. That's the dynamism of an economy. That's what drives free enterprise. That's what drives creative thought processes and value creation in a growing economy. Is like rewarding, recognizing entrepreneurs. So yeah, it'll be interesting to see how it all plays out. And obviously, a lot of the negatives in China are out there. My view is like Tencent's the best. It's the highest quality asset in China. They've got double-digit earnings growth. PE is 15. But I only have a couple of points of exposure to it. And I'm going to wait 2 or 3 years and we'll see what happens. It's definitely a challenging country. I think the other angle on China is that it's one of the few markets in the world that offers genuine diversification. If you're net long American equities, which most of us are, or it's orthogonal to United States in so many ways, geopolitically.
That's for sure.
Let's see. Yeah. So if I can find the good asset there, like where I think long term will go up, hey, that can be interesting to make.
Not to belabor it, but two more points. One is owning real estate in China. It's all a long-term ground lease from the government, right? And that expires this century. So the government can say, you know what, we tried this experiment with capitalism or communism, capitalism, and we don't like it. We're taking back their land. Or they could just not even wait till it expires and say, we tried it, we didn't like it. But there's that dynamic, which is admittedly left tail and improbable anytime soon, but not impossible. And then the other thing to your point is, they are not acknowledging the problem with the banks and bad loans and bad debt and all of that. And to your point, in the US, we have these crises and we say, all right.
Every decade we get a banking crisis. Savings and loans, LATAM banks in the early 80s, 2008. We have the CRE issues now.
Imminent. That's a good topic if you want. Yeah. That's the next shoe to drop for the regional banks and in America, the CRE crisis.
Let's go there. We have $2 trillion in commercial real estate loans on American balance sheets that are occurring in 4 years. Well, I heard that stat about a year and a half ago. So assuming it's straight line amortization, you've got about 1.5 trillion to go in 3 years. If you look at the stock market,
I want to interrupt you there.
Go ahead, yeah.
It's not straight line amortization because a lot of that was refied and kicked.
Pretend and extend. We kicked it out.
Lend, pretend, and extend. Exactly.
Lend, pretend, and extend. Why don't you frame up the issue on CRE? What are the challenges? Where are we now? Where are the bodies buried?
Yeah, you were alluding to it, but the banks have what's transpired. You were in 14 years of ZIRP, zero interest rate policy, quantitative easing. That ended a few years ago, and rates went from effectively 0 to 5. When rates rise, cap rates rise, which is the value of properties are inherently worth less. In a 5% interest rate environment versus 0, properties are worth a lot less, as are most assets. And you've had NOIs, net operating income, the cash flow from real estate decline because of labor, insurance, operating expenses, etc. You've had loan to values decline. You have occupancies decline from structural changes like post-pandemic work from home and office occupancy that's massively diminished. You put all those factors together and you have properties where if a typical equity is 20% and you're levered 4 to 1, the equity is more than wiped out. And you have these banks who have these loans and so to convert all that into where the opportunity is for great investors, I think it's very alpha basis, not scattershot.
I agree. Security selection. You got to pick them.
You got to pick the proper property. You can't just go and say, I'm going to buy New York City real estate, irrespective of class, location, at 40% down because it's going to be a double. No, not at all. Some of those properties will be unrepositionable, worthless. You would need tax zoning change and or government incentives to reposition certain properties.
I totally agree. We think secondary markets that are less competitive and markets where you don't have trophy properties are the place to focus. You make your money when you have uncompetitive bidding and you've got a non-economic seller like a community bank who's got regulatory pressure from the regulator to clean up their balance sheet. Those are interesting opportunities. $15 to $25 million nuggets that you can pick up in markets where there's still population growth and good fundamentals, but they just have an upside down balance sheet on a fundamentally good asset. We think that's the way to play it. But you look at stocks like SLG and commercial real estate exposed businesses, you would never guess that there is a commercial real estate, I don't know what the right word is, issue or crisis. Impending. This is SLG, right? So SLG is described as Manhattan's largest office landlord. It's a REIT, and this stock is approaching all-time highs. I'm not saying own this, but I wouldn't want to own it. But there's no sign of commercial real estate risk. In the banking crisis, you can see here, bottomed on March 27th, 2023, right in the heart of the banking crisis. And those are the lows. And it's done from $18 a share to $65 a share. It's been an extraordinary return. I think there was some value around the lows. I think it's overshot here due to our earlier topic on reflexivity. But there are other REITs I could show you, right? Vornado, which has fantastic management team. A jockey can only do so well based on the horse they're riding and the hand that they're playing. If you look at Vornado, similar story, similar type of pattern as well. It's got a 380 trailing PE, looks like. So why aren't public markets concerned? How about Bank of Ozarks? Bank of Ozarks has a lot of exposure to commercial real estate. That bank hasn't done as well as the others. It did bottom around the same time in the low 30s, not to 41. So it does have this overhang around it. It's got a forward P of 69. Most banks, you should look at tangible book value. Arguably, tangible book value is lower than what's reported in the financial statements. I think that would make a lot of sense. But why haven't financial markets priced in the impending shoe to drop?
Great question, Rob. I think you're spot on. I couldn't agree more with you if it's a statement, not a question. Look, there's an argument that markets are efficient. I don't think they're efficient. This is a great example where it's quite a disconnect. For example, let's look at cities. There's a property by the White House that recently sold for 50 to 65% of the last sale price. We're talking about, let's say, 800 million sold for 400 million or a few hundred million. New York City, same thing. Blackstone sold the property that it had bought for, let's call it 600-700 million for 300-400 million, down 50%. These are A properties or B plus A properties in irreplicable locations where one cannot build new construction with an inherent demand, whether it's in DC from government or in New York City from various tenants. The point is they're great properties with bad capital structures and no ability to build, minimal ability to build new. So my point is this There's your strategy, which was B properties last picked over, but also, or B cities where there are forced sellers. Great. But then you also have these A properties in A cities where there are, again, forced sellers, whether they're regional banks or large asset gatherers or owners who, for whatever reason, are taking losses.
Yeah, I think the pretend and extend is happening now. When does that stop? Is there a forcing function that creates a reckoning? Back in the '08 crisis, it wasn't until 2011 that we saw real markdowns, single family residential properties. And that's when the private equity machine got going. Invitation Homes spun up. That's when you and I were talking about the same issue way back when. The move back then was to scoop up and buy these assets. I was talking to a distressed CRE manager we're actually invested with. He said, it's pretend and extend now, but the reckoning will be here in a year or two. I want to find the mechanism of action that's going to force liquidations and selling. You have rate cuts happening now too, right? If you look at the XLRE index, this is at 52-week highs. It's softening now. I think a lot of these rate cuts are not fully priced in. I'll share it on the screen here, but look at that. It's actually, was that all-time highs? No. 52-week highs, not too far from all-time highs. Nature is healing with the onset of these rate cuts, and we just haven't seen in public markets these issues, although in private markets, you are seeing transactions take place, and other folks aren't required to mark to market. If it's a private transaction, they're only required to mark to market when they cannot meet a debt payment. And if the bank doesn't do a workout with them, then there's the reckoning. The banks want to do workouts. The banks they'll do the equivalent of an interest-only loan if they can, just to keep the loan current and avoid an impairment on the balance sheet. And of course, these banks also have issues with unrealized hold-to-maturity losses on the balance sheet. And the regulators know all this too.
Oh, don't get me started. HTM, hold-to-maturity, the duration crisis on First Republic, Silicon Valley Bank, Signature, and on. That still hasn't gone away, right? Because there were a lot of long-term treasuries, agencies, loans that if they were forced sellers today at 5.25% SOFR market versus when those loans were made or securities bought, the hits to their balance sheets would be massive. For the regional banks, to use the 1-2 punch expression, you've got the duration that would hit their equity, and then you have this impending CRE. To your point, you mentioned one bank. I think you could mention a ton of them where they're just not pricing in the reality of what's coming. Now, one mitigating factor you alluded to will be rates are likely going lower, not higher. And the more, the better, and the sooner, the better. And that will be a tailwind. I don't think it solves it, but
if they can earn through these balance sheet impairments, then they'll be okay. They come to the other side. That's probably the strategy of the regulators and bank management. They have unrealized losses. As long as they can borrow short, lend long, there is some increasing bank credit growth as well. It hasn't actually stalled out, hasn't gone negative. And bank earnings were solid. Now that's mostly mega cap banks, which don't have these CRE issues because it's mostly
correct
small local community banks on the regional side. Here's a chart of the 10-year. The 10-year was like 1.5% before the Fed started hiking rates and even got quite a bit lower. And now we're at 3.7. We peaked out nearly at 5 in October of last year, which was near a stock market low. The higher the 10-year, the greater the unrealized loss on agency mortgages and treasuries that the banks own and park at the Fed. So the 10-year coming down helps the banks. It's still a far cry from 1.5% some time ago. The Federal Reserve can always bring back bank term funding program if they want. So they still have levers. We'll see how things evolve, but pretend and extend seems to be working for at least the first 2 years of this rate hike journey.
Yeah, that's right. But I think you're starting to see, like I mentioned, the transaction in DC, it's very public. There's the one that Blackstone sold in New York. San Francisco, again, same thing, very public sales. The beauty is if you're a distressed buyer now and the prior sale price was 800 million and now you're a buyer at 400 million, your economics are very different in terms of your ability to generate a good return and charge per square foot. If your neighbors all have the same basis as the 800 million per square foot, meaning 800 million amortized or divided by the number of square feet, right, all of a sudden your basis is half. You can go in there, and whereas your neighbors are charging $100 per square foot, you could go in there potentially and say, I'll charge 50 per square foot. And then all of a sudden, you're re-rating the market down to this higher cap rate, lower valuation. It's a massive problem for existing real estate holders and existing debtors and those that are the lenders.
Yeah, I know it's going to be challenging, right? Especially for folks that have floating rate loans that are just hanging on by their fingernails, and the rate cuts can't come fast enough for them. And even then, it's going to be challenging, right? Because they took out a loan when the 10-year or LIBOR was substantially lower. Even with 50 bips cuts, it's just not enough. Even 100 bips cuts, it's also still not enough. Then you have the work from home dynamic around it. Yeah, it's a difficult category. I just find it remarkable that you just don't see it in public markets. And maybe it's a sign of the enthusiasm around public equities and where we've gone.
Yeah, there are very famous shorts in the first housing bubble, right? Not the first, but the most recent large housing bubble, 07, right? You had Paulson, you had Michael Berry, you had some other very well-known people, The Big Short, all that. And there were lesser known people like myself who were also, it was quite apparent that there was a housing bubble.
So you think we'll see that play out? We just got to be patient and wait.
I do in real estate. The one that's lend, extend, and pretend that I don't see it playing out is private credit. I think they've done a good job kicking the can down the.
I know there's a lot of talk about private credit, and we move the risk out of the bank system to private credit. We can't size it, which is true. It's hard to measure that. But I'm less concerned about that because those are private losses. They're not socialized. You don't have a loss of confidence in the banking system if a private credit fund.
That's right.
Doesn't work.
I agree.
So I'm less concerned about it. It'd be great to get more transparency around it. I think they should all put it on chain. We'll figure that out later one day. But if you are correct, though, that we will see a CRE down cycle that impacts bank balance sheets, that's meaningful. The mega banks won't be impacted. The banking system overall should do fine. They may be caught in the sentiment downdraft of it. But if regional banks are under pressure and community banks, and that hurts lending, and they're lending to multinational corporations and folks that really don't need loans, they're financing assets like airplanes and all the rest. That would be a major concern that could slow down economic growth or create another banking crisis redux. I'm not there yet. I find your point really interesting to process and think through.
Yeah, look, I think if you choose distressed operators, you need people who have been through prior cycles, have the ability to work out, release, redevelop, and are, to me, it's very property specific.
We need to wait for the opportunity to present itself. There are opportunities now, some of the properties you named. The people that are buying a great asset with the right capital structure, they'll make money, and you find the right strategy.
Totally.
Like the wholesale buying, remember like 2011?
I wouldn't do it.
Back then, we thought that you needed the analytics, you need index, you got to go figure out, no, you can just go buy. And look, yes, certain markets are better than other markets, but if you just bought the bag, you did well. Sorting the bag didn't really matter. Getting exposure mattered. We're far from that now. The question is, when does that happen? What triggers that? Especially when you have rate cuts that are happening and regulators maybe are more permissive in helping the banks get through to the other side. And I wouldn't be surprised if we saw more bank M&A activity that would help. Regionals probably gobble up smaller banks. Larger banks probably gobble up more regionals. Larger banks have better, deeper balance sheets, et cetera. Interesting times. That's a good left tail risk to consider.
If you look at the earlier large GFC housing crisis, you had people like WAMU, right, and Washington Mutual and others of these large entities that had gobbled up and consolidated in through M&A, and they imploded. Adding a bunch of insolvent or weak players together creates a bigger problem that's easier for the Fed to let JP Morgan bail out and pick and choose what it wants.
Why don't we conclude on the last topic? Thoughts on AI? Where are we with AI?
The technology is real. I co-founded Move 37 8 years ago to invest in managers using machine learning and alternative data. I co-founded the Artificial Intelligence Finance Institute. I've written white papers on this. AI has been real it's been around since post-World War II. It's been real for 10 years now because of 4 factors: record low processing and storage cost, exponential growth of data science, and various other factors. The point is the private equity or VC of AI, I think, is excessively overvalued, egregiously overvalued. I think probably it's a similar case for most, if not many, of the publicly traded equities. The technology is real. And I think though VC, venture capital, X AI, so outside of AI, is super interesting and washed out, particularly early stage seed, AB. I think that's super interesting now. And I think that vintage will be akin to post first tech bubble when I left Soros in 0102, where those vintage years were just phenomenal.
So you think the best way to position is on early stage, seed, series A, in AI as the category, or adjacent?
No,
Not AI, because AI is
XAI.
overblown.
Yeah.
AI, sorry. Okay, perfect. That makes sense. I buy that because I think the startups that can benefit from the enabling tools of the AI will be far more productive at much lower cost, and you can get a better valuation. They'll be free cash flow positive faster. They can grow more quickly. I agree. I think the enablement play makes a ton of sense. I agree. I think AI startups is mostly a head fake. I think picking winners is extremely difficult. The velocity changes way too much. Look at OpenAI. They raised at 86 billion last year. Now they're raising 100 billion now. So you made a mid-teens return for giving up liquidity, and they're burning billions in cash each year. Now they need a bailout from NVIDIA, and they're going to head against Meta.
And Apple potentially too.
And
right?
Apple and Google. And then that doesn't include startups like Perplexity and Claude, Anthropic, all this other stuff. So yeah, I agree. I think that's the right way to look at it. AI is the FOMO trade in private and public markets. Microsoft is expensive and priced in for AI. It's going up 9% this year, lagging all the major indices. It's expensive on its 4 PE basis. And the semiconductors, I think there's still room to go. You have industrial policy behind this. You've got governments like Saudi Arabia building 60 data centers. You got Japan with their own version of the CHIPS Act. You've got Europe with their own version of the CHIPS Act. People want chips. The ROI on CapEx spend is going to come faster than most people think. Meta is seeing it right now and improved ad targeting. I'm more constructive on that side in public markets, but things are pricey. There's no doubt about it, right? Taiwan Semiconductor had a 4P of 15 summer of last year. Now it's 20, and 20 is on the high side. This is like the 85th percentile of valuations.
I was speaking with a former colleague, portfolio manager from Soros at a different time there. And I definitely won't say who, but he was giving me the bull case for Taiwan Semi today and the bear case for Intel. His view was Taiwan Semi is just a huge beneficiary prospectively and huge long here, if I'm not misstating what he said. And Intel could actually be bailed out by the U.S. government. That's how bearish this PM was on Intel.
I'm bearish on Intel as well. The company has got so many serious issues around it. It's priced below tangible book, but I don't know if that matters because what's the value of the book value? Anyway, I agree. The bet is on earnings growth. You have to believe that the valuations are higher because earnings growth will be higher. That's also challenging though, because of Taiwan Semiconductor to create more earnings growth, they need more foundries. There's a finite number of capacity that they can bring through. And it takes years to build these foundries. And then ASML, who is a monopoly backing Taiwan Semi, they've got a backlog. So you're seeing price increases. Taiwan Semi raised prices. NVIDIA took it on the chin. They lowered their margin from 80% to 75% because their number one customer, Microsoft, can't take it anymore. Who's feeling the margin pressure? I'm more optimistic on the semis play in public markets. I think it's a long-term secular trend, but the opportunity ahead is less attractive than it was a year ago, just given where valuations are.
Yeah, two things. I've been investing in semis for 30 years, as probably you have. They're cyclical. Semis are cyclical. It is a cyclical industry. It is not a secular growth. It's going to be cyclical, boom, bust, as it always has been. And it reminds me of when I was on the investment committee during the recent tech bubble a few years ago, where I said, how is this different than the first tech bubble when I was a PM at Soros? And I get all these excuses. The growth rates are higher, the multiple to growth rate. And you know what the answer was? I was right. It was another tech bubble valuation.
Isn't a question of when. I love that perspective and going back to history there. Is this 1996 to 1997? Or is it 1999 to 2000 where you had the peak in the CapEx spending with Y2K and all the fiber investment, and then that rolled over and the rest is history? If it's earlier in the cycle, then maybe it is like the tech bubble of the late 90s, but we still have room to go.
Time will tell.
Thank you, Michael. That was terrific. Really enjoyed it. How can folks stay in touch and learn more? I know you write, I believe, on LinkedIn.
Yeah,
Name-
I'm on LinkedIn pretty publicly, Columbia Business School. I have a podcast as well. We'll have to have you on sometime.
What podcast?
Improving Alpha,
Ooh,
Innovation
I
in
like that.
Investing, ESG and Technology.
Cool.
LinkedIn, Michael Oliver Weinberg. There are 50 Michael Weinbergs, but only one with Oliver in the middle.
Michael Oliver Weinberg. Thank you so much. Until next time, take care.
Thanks, Ram.
Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Ahluwalia, your host and Chief Investment Officer at Lumina Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.